Broadcom just announced earnings for their third quarter of fiscal year 2023 for the period ended July 30th. And we can see that over the last year, their stock is up 67%, while the rest of the market is only up 10%. So they're outperforming the market over the last 12 months. So in this video, I'm going to look into some of the recent news that came out surrounding Broadcom. I'm going to look into their financial statements, and then I'm going to use a discounted cash flow model to figure out the intrinsic value per share for this company. So right here in this article, it's titled Broadcom reports slowing growth as it awaits final VMware accusation approval. Is it time to buy the stock? And some key points they touch on right out of the gate include the fact that their sales slowed once again last quarter, but it's still outperforming most of their peers in the semiconductor industry. Also, their company is generating incredible amounts of cash at the moment, and they hope to replicate their past successes with this new acquisition of VMware. Right here, they point out that in the first paragraph and the second paragraph, Broadcom is outperforming peers, and they have a pending merger with VMware, which is a cloud computing infrastructure company. They point out that excluding NVIDIA's massive GPU boom, a lot of companies in the semiconductor industry are in a deep slump at the moment. For example, Marvell Technology, which is one of NVIDIA and Broadcom's main competitors, basically reported a 12% year-over-year decline in sales and a resulting slump in their profit margins. But Broadcom and NVIDIA are different. We can see that Broadcom is up 5% year-over-year, increasing in revenue to $8.88 billion. Their earnings per share and their free cash flow are up 8% and 7% respectively compared to last year as well. And they also have free cash flow profit margins that are at nearly 52% during the quarter. So we can see right here in this paragraph, it's also pointing out that their 5% revenue advance in the third quarter, although it's increasing revenue, it does represent a sharp slowdown in growth from 8% growth in the second quarter and 16% growth for their revenue in the first quarter. But that being said, as they point out right here, growth is growth. And it's especially notable in a market where a lot of semiconductor companies are experiencing declines in sales, whereas Broadcom is experiencing growth, even if it is just a little bit of growth. Right here, we can see the breakdown of their sales by their operating segments, networking, wireless, and so on. We can see the majority of their revenue is made up by their networking segment, which came out to about $3 billion worth of sales. So what about the VMware acquisition? We can see that Broadcom recently received regulatory approval to acquire all of VMware in all jurisdictions except for China. The CEO is confident that approval will be granted and the two businesses will combine by the end of October, which is the end of Broadcom's 2023 fiscal year. Basically, VMware is a pretty successful company by themselves. Over the last 12 months, their sales were up to $13.6 billion, up 3.6%, and their free cash flow rose 47% to $4.6 billion, with a free cash flow profit margin of 34%. So Broadcom basically hopes to boost cash generation by folding VMware into their existing infrastructure software business, similar to the other acquisitions that they've done over the past decades. VMware at the moment is valued at a pretty substantial market cap of $71 billion at the time of writing this article. And Broadcom is basically acquiring the company half with Broadcom stock and then half with cash. Based on this valuation, they're basically buying VMware at 16 times free cash flow, which is actually a pretty good price to buy VMware at if they're able to juice free cash flow profit margins to 50% and beyond for this acquisition, similar to what they've done to other acquisitions in the past. So to top it all off, is it time to buy Broadcom stock? In late 2022 and early 2023, they were a really good buy at the time. They were a value trade, but since then their stock has increased in value quite a bit, so that value trade is now gone. But still at 21 times trailing 12 months free cash flow, they're by no means an expensive stock. They've had a great dividend growth story. They're not just a growth company. They also pay a pretty substantial dividend, as we'll see in the later analysis in this video. And once they're able to fold VMware into their underlying software infrastructure, they stand to increase their profits even more and return even more back to shareholders through common stock repurchases and also through cash dividends. So right here in their financial statements, we can see this is for their balance sheet. Total assets came out to $71.5 billion, and they have $22 billion of equity and $49 billion of total liabilities. We can also see right here, this is their income statement. Net revenue came out to $8.8 billion, up 5% from $8.4 billion. And then net income came out to $3.3 billion, up 10% from $3 billion in the past quarter. Lastly, on page 7, we can see this is their cash flow statement. Operating cash flow for the period ending July 30th, 2023 was $13.2 billion. And then we can also see, well, we can't really see it right here, but for just the last quarter alone, their operating cash flow was $4.7 billion. And then of the $4.7 billion, they had $4.5 billion of free cash flow. So that's cash flow after they invested back into their company. So it's obviously a very positive metric. As the article pointed out, this company is very cash rich, which is a great sign for investors. Lastly, in their financing activities, we can see in terms of payments of dividends, they've paid out $5.7 billion worth of dividends. $1.9 billion of that came in the last quarter at about $4.60 per share in the last quarter alone. And then also repurchases of common stock. We can see they've repurchased so far $5.7 billion, and about $2.1 billion of that came in the last quarter. So right here, we can see this discounted cash flow model for Broadcom. I'm using a growth rate of 14%. I got that from their last 5 years of free cash flow growth from 2018 to 2022. Cash flow growth grew from 8 billion to 16 billion, which compounded annually comes out to a 14.63% compounded annual growth rate. The weighted average cost of capital that I'm using to calculate the discount rate for this model comes out to 6%, just about. I got that from this calculator right here. Their interest rate in their most recent full year for their debt was about 4.4%. Their effective tax rate was 7.5%. The current 10-year treasury yield is 4%. That's what we use to calculate the cost of equity, as you can see right here. And we see that for their beta comes out to 1.12. So Broadcom stock is a little bit more volatile than the rest of the market. And so right here we can see we use their risk-free return of 4.29 plus the beta of 1.12, and we multiply that by the average market return of 10% and subtract the risk-free return. That gives us their cost of equity, which is 10%, compared to their cost of debt, which is 4%. On their balance sheet, we saw that most of their business was financed by debt compared to equity. They have about 70% debt, 30% equity. And so if we multiply the equity proportion by the cost of equity, add that to the debt proportion multiplied by the cost of debt, and then multiply the debt proportion by the tax shield, since debt is a tax write-off, we can do that by doing 1 minus the tax rate of 7.5. That gives us the weighted average cost of capital for Broadcom of 6.15%, as we see right here. Free cash flow for the start is 16.3 billion right here, as we see. They have a net debt position of 27 billion and 400 million shares outstanding. Puts their intrinsic value per share at around $948 per share, which means that at the current share price, they are trading slightly below intrinsic value per share if they are able to continue to grow their free cash flows for the next 5 to 10 years at the same rate that they've grown them over the last 5 years, which could be a lot to ask considering the fact that they grew compounded annually at 14%. But if they are able to do it, then they would be trading at a little bit of a buying opportunity at the current share price. For the industry analysis, I compared Broadcom to NVIDIA and Cisco. We can see that across the board, Broadcom is very competitive. They have one of the highest gross profit margins, basically tying Cisco's 62%. And they have the highest net profit margin, highest return on assets, and the highest return on equity. Keep in mind, though, for the return on equity metric, they also have the highest debt to equity ratio. So they obviously finance their business more with debt than NVIDIA or Cisco with their 0.5 and 0.2 debt to equity ratios. With that being said, Broadcom does have higher profit margins than their two competitors here. They also, as we can see right here, have a very competitive price to earnings ratio. NVIDIA at the moment is trading at the most expensive price at a little over 100 times their most recent earnings, whereas Broadcom is trading at 26 times earnings. Not as good as Cisco's 18 times earnings, but it could be because investors are pricing in a little bit more growth to Broadcom than Cisco. And then we can see lastly, dividend yield. definitely goes to Broadcom. They pay the highest dividend yield of 3.47%, $16 per share for the entire year. They paid about $4 in the last quarter per share. So basically for every $100 you invest into Broadcom, you're getting paid $3.47, give or take, per year. So based on this, on these financial ratios alone, if you were just isolating these ratios and you weren't taking into account anything else, you probably definitely want to give it to Broadcom because they have the best profit margins, a competitive price to earnings ratio, and they also pay out the highest dividend yield out of the three companies. So the competitor analysis goes to Broadcom. Lastly, I wanted to compare Broadcom to some of the other companies we've looked at in past videos. Broadcom's share price to intrinsic value takes the 9th place spot out of all of the companies we've looked at. Occidental Petroleum, ExxonMobil, we can see ConocoPhillips and Chevron, oil companies that are taking the list here. Also AMD, which is also another company in the semiconductor industry, competitive to Broadcom. Then we have Google, Alibaba, Albertsons, and Apple. There are other companies that are sitting on the intrinsic value list at the moment. And we can see for growth rate, Broadcom comes in 10th place with a 14% growth rate for their cash flows. AMD had the highest so far, 83%. For profit margins, we can see Broadcom is very competitive. They have a 62% gross profit margin, puts them in 9th place. Adobe had the number 1 spot with 86%. But then we can see for net profit, they're extremely competitive, coming in 2nd place across all of the companies we've looked at, which is definitely very impressive, a 34% net profit margin for Broadcom. For dividend yield, Broadcom is also very competitive compared to other companies we've looked at. Intel, which is another company competing with AMD, NVIDIA, and Broadcom, had the highest dividend yield at 5.52%, but Intel's return on their stock's growth was not nearly as impressive as Broadcom's. Intel lost growth over the last 5 years, whereas Broadcom increased. So that coupled with the dividend yield is definitely very impressive for Broadcom, putting them in 4th place right here. Year-over-year revenue and earnings growth for Broadcom for the second quarter wasn't really, or for Broadcom's 3rd quarter of their fiscal year, but 2nd quarter of the year wasn't really that impressive. They had revenue growth of 5% and net income growth of 10%. We can see that one of their main competitors, NVIDIA, comes in 1st place for 2nd quarter year-over-year revenue and earnings growth, with 100% revenue growth and 800% earnings growth. We can see across all these tables, there are definitely a lot of spots that are taken by these semiconductor companies. So this industry is obviously experiencing a boom right now as a result of artificial intelligence. But unfortunately, Broadcom wasn't able to make it onto these two tables. Lastly, for stock performance, we can see that Broadcom is up 262% over the last 5 years, or 266%, as we can see right here. As the article pointed out, at late 2022, right around here, they were trading at a pretty good buy at around $400 per share. But since then, they're now trading at $860 per share, almost up to $900 per share. So Broadcom does have a very competitive return over the last 5 years, coming in at 7th place. NVIDIA and AMD, two of their main competitors, are also on the table with a 500% return for AMD, 650% return for NVIDIA, but nobody has been able to beat Tesla's return over the last 5 years, which is 1,144%. So based on this, Broadcom is obviously very competitive. They have a competitive stock market return, competitive profit margins, very competitive dividend yield, and they are also trading below intrinsic value per share based on the metrics that we used in this discounted cash flow model. And then compared to the other companies in their industry, NVIDIA and Cisco, they have the best profit margins and also a competitive price to earnings ratio and the best dividend yield. So let me know in the comment section down below what you guys think of Broadcom. Is it a good buy at the current share price? Let me know your thoughts in the comments down below. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.